Why is AUDUSD not rallying despite a hawkish RBA hold? At 0.7075, Australian dollar to US dollar just shrugged off a hawkish RBA hold. That's the first clue. The market isn't buying the hawkish rhetoric. Price spiked 5 pips, kissed 0.7102, and then spent the next 6 hours drifting lower while the headlines were still fresh. Think about that. A central bank says it's ready to hike again, and the currency barely holds its breath. That tells you everything you need to know about where the real pressure sits. There is one danger zone and one hidden opportunity right now. I'll show you both. Stay to the end. I'm giving you 3 exact levels you can trade today, and one of them is a sniper setup that aligns with a 4-hour divergence most traders haven't even spotted yet. This session, the instant market verdict. We are range-bound with a bearish lean below 0.7094. The short-term charts are screaming strong buy, but the higher timeframes are sitting on their hands. That makes this a classic bull trap zone. The single invalidation level that flips the bias from range to short into breakout long is 0.7118. Write this number down. If we get a daily close above 0.7118, the entire bearish structure resets, and we are targeting 0.7146, then 0.7200. That's the line that separates the trapped longs from a genuine trend shift. Right now the herd is positioned long. Retail sentiment is long. The RBA hold has everyone leaning bullish, and that's exactly why the trap is so clean. The Aussie dollar is the China proxy, and China isn't playing along. Iron ore is heavy, the yuan is leaking, and risk corridors are contracting. That disconnect is the profit engine for the next 48 hours. If you're long here without a hedge, you're swimming with the herd into a pool of liquidity that the smart money is already fading. Let's go top down and I'll show you exactly what the charts are screaming, starting with the weekly. The weekly trend is still a buy. Price is well above the 200-week moving average at 0.6892. That's the macro anchor, the multi-year demand zone. The 100-week moving average sits at 0.7037 and has been sloping higher for 3 months. So structurally, the long-term picture says dips are buys. But here's what most traders miss. The weekly MACD histogram has been flatlining for 4 consecutive weeks. The signal line is curling lower. Momentum on the weekly has peaked. So yes, the trend is up, but it's running on fumes. The daily chart is neutral. And neutral at the top of a range is not where you want to be initiating fresh longs. The 20-day moving average sits at 0.7099, just above current price, and it has flattened completely. The 50-day at 0.7113 is acting as a ceiling. Look at the last 4 daily candles. Each time price poked above 0.7090, sellers stepped in. The daily MACD is negative, minus 0.003, and the fast line is below the slow line. That's not a screaming sell, but it's not a buy signal either. When the daily RSI is at 45 and the ADX is at 37, you have a strong directionless market. That's a coiled spring. The ADX is telling you a big move is coming, but it's not telling you which way. The way you figure that out is by watching the boundaries now drill down to the 4H. This is where the hidden divergence lives, and it's the piece of the puzzle that will change everything for your trading this week. On the 4H, price made a high around 0.7140 about 10 days ago, then sold off to 0.7014, and has since recovered to 0.7094. That recovery looks like strength. But the 4H MACD made a lower high during that bounce. That is a textbook bearish divergence. Buyers are exhausted. They've had 2 attempts at 0.7094 and both times got rejected. The 4H RSI is at 45, not oversold, so there's still fuel to the downside. The 4H 20 MA is rolling over at 0.7090, and the 60 MA is flat at 0.7085. These moving averages are squeezing together. That's another volatility compression signal. On the 60-minute chart, we do have a strong buy signal. The 1H MA5 and MA10 are trending higher, and price just bounced off the 60-minute 200 MA at 0.7066. That's the pivot. That bounce gave us the current 0.7075 handle. But short-term momentum is not trend. And when short-term momentum collides with higher timeframe resistance and a bearish divergence, the higher timeframe almost always wins. The liquidity above 0.7094 is a magnet for stop hunts. The real supply zone is 0.7094 to 0.7118. That's where you want to be fading, not chasing. Now let's put numbers on it. Key support levels. S1 is 0.7042. That's the 100-hour moving average and a prior swing low from 2 days ago. S2 is 0.7014, the September demand zone, and also the level where the RBA hold was fully priced in. S3 is 0.6990, which is the weekly structure support and a level that if broken, would signal a much deeper correction. Resistance levels. R1 is 0.7094, the pivot and the 4H supply zone. R2 is 0.7118, the daily 50 MA and the structural breakdown level from the last FONC minutes drop. R3 is 0.7146, the local top. The pivot is 0.7066. That's your intraday barometer. Above it, bulls have short-term control. Below it, the trapdoor opens. Here's what most traders miss. The daily ATR is 55 pips. That means the average daily range is 55 pips. From 0.7094 to 0.7042 is 52 pips. That's almost exactly one average daily range. So a rejection at resistance can easily run to the first support within a single session. That's the maths the algos are watching. They will load up shorts at resistance and let the range do the work. Now let's connect the fundamental driver. The RBA held rates at 4.35% as expected, but the statement retained the wording that the board is not ruling anything in or out. That's a hawkish hold. Governor Bullock spoke about upside inflation risks and sticky services prices. Normally, that would push Australian dollar to US dollar higher. But it didn't. Why? Because the market is pricing a global growth scare. The Chinese data flow has been dismal. Industrial profits are down. The property sector is still contracting. Iron ore futures dropped another 2% in the Asian session. The Australian dollar cannot sustain a rally when its biggest export commodity is sliding and the Chinese yuan is weakening. The yuan fix has been consistently lower, and that drags the Aussie with it. Meanwhile, the US dollar is getting a safe haven bid from geopolitical noise and from a Federal Reserve that is pushing back on near-term rate cuts. The 2-year US-Australian bond yield spread has moved against the Aussie by 8 basis points this week. That's the real driver. The RBA can talk hawkish, but if the spread is moving in the dollar's favor, the AUD will struggle. Cross-asset linkage confirms it. The S&P 500 futures are pinned at gamma resistance. The VIX is holding above 15, and any pop toward 18 will send risk proxies like the Aussie tumbling. Bitcoin, the purest risk asset shadow, is also coiling but showing bearish MACD divergence. That's a multi-asset correlation. Gold is firm on geopolitics, but that's a fear architect bid, not a risk-on bid. So the China proxy trade is flashing amber. My 1 to 2 week directional lean is a grind lower towards 0.7014, followed by a liquidity sweep of 0.6990. The only event that completely invalidates that view is a daily close above 0.7118. If we close above that, the risk corridors flip back on, and you can load longs towards 0.7200. The exact event that could trigger that is tomorrow's Chinese industrial production and retail sales data. A beat there could spark a sharp short squeeze. Do you think the dollar breaks 105 this week? Comment yes or no. I'm tracking consensus. The dollar index is sitting at a critical level, and its move will directly dictate whether this Aussie range resolves up or down. Most people skip this section. That's exactly where the money is made. Keep watching. I'm giving you 3 battle-tested trade plans with exact entries, stops, and risk-reward ratios strategy 1, the sniper. This is the conservative, high-probability play that exploits the bearish divergence on the 4H. You wait for a 4H candle close below 0.7066. That's the daily pivot. Don't anticipate the break, confirm it. Once we get that close, you enter short. Your stop loss goes at 0.7105, just above the 0.7094 resistance and the 1H swing high. That's a 39 pip risk. Take profit 1 is at 0.7042, the first support, which gives you a 24 pip gain. But we are not done. Take profit 2 is at 0.7014, the demand zone, for a total of 52 pips on the full position. If you hit TP1, move your stop to break even and let the rest run to TP2. The combined risk to reward to TP2 is 1 to 1.33. It's not a home run, but it's a setup that prints consistently in range to down environments. The setup is void if we get 2 consecutive 4H closes above 0.7094. That would signal absorption, not rejection, and the sniper stands down. The sniper, conservative, entry. Sell on 4H close below 0.7066 stop loss, 0.7105 take profit 1. 0.7042 take profit 2, 0.7014 risk, reward, 1:1.33R, to TP2, invalidation. Void if 2 consecutive 4H closes above 0.7094 strategy 2, the active trader. This is the standard play for those who want to exploit the bull trap. Here's how it works. We wait for price to poke above 0.7094, maybe to 0.7100, and then aggressively reverse. You need a 1H candle that closes above 0.7094 and then the very next 1H candle closes back below 0.7090. That's your trigger. Enter short at the breakback below 0.7090. Stop loss at 0.7120. Above the daily 50 MA and the structural ceiling. That's a 30 pip stop. Take profit 1 is at 0.7055, just above the pivot and the 60-minute 200 MA, locking in 35 pips. Once TP1 is hit, move your stop to break even and trail by 15 pips on the remaining position. Take profit 2 is at 0.7014. This setup has a risk reward of 1 to 1.16 to the first target, and 1 to 2.53 to the second. The active trader setup is invalidated if we get a 1H close above 0.7118. That would indicate the breakout is real and the bull trap failed. This is the setup that catches the breakout chasers and uses their liquidity as fuel. The active trader, standard, entry, short at 0.7090 after 1 hour close above, then reversal below 0.7094 stop loss, 0.7120 take profit 1, 0.7055 take profit 2, 0.7014 risk, reward, 1 minute and 1.16 seconds to TP1, 1 minute and 2.53 seconds to TP2 invalidation. 1H close above 0.7118. Type your Australian dollar to US dollar range for tomorrow in the comments right now. I'm looking at 0.7042 to 0.7094 as the highest probability band. Let's see who's aligned. The comments are a goldmine of crowd psychology, and I read them every day. Strategy 3, the aggressor. This is for traders who can handle heat and want to scalp the counter-trend bounce. If price drops to 0.7042 and we get a bullish engulfing candle on the 15-minute chart, with the RSI crossing back above 30, you go long. Entry at the close of the engulfing candle, around 0.7045. Stop loss at 0.7020, below the swing low and the 0.7014S2, risking 25 pips. Take profit 1 is at 0.7075, which is current price, for 30 pips and a 1 to 1.2 risk reward. Take profit 2 is at 0.7094, the pivot resistance, for 49 pips total, giving a 1 to 1.96 ratio. This is a pure mean reversion scalp that bets on the pivot holding as support. It goes against the higher time frame bias, so position size must be tiny. The setup is void if we get a 15-minute close below 0.7035. That breaks the support structure and opens the trapdoor. Only trade this if you can lose small and manage risk aggressively. The aggressor, high risk, entry, long at 0.7045 on 15 minutes bullish, engulfing at 0.7042 support, stop loss, 0.7020 take profit 1, 0.7075 take profit 2, 0.7094 risk, and reward, 1 minute and 1.2 seconds to TP1, 1 minute and 1.96 seconds to TP2 invalidation. 15-minute close below 0.7035. Now the risk management pulse. Never risk more than 1 to 2% per trade. No positions through high-impact news, especially Chinese industrial data or US jobless claims. Stops are non-negotiable. If 0.7118 breaks to the upside, you cut shorts instantly. This is how you survive to trade the next big move. The Aussie will give you another setup. Your job is to still have capital when it arrives. Today's critical level is 0.7094. A daily close above that, and the bear thesis is on life support. A rejection there, and we are measuring the move to 0.7014, and possibly 0.6990. Tomorrow's wildcard is the Chinese industrial production print and iron ore futures open. I'll be breaking down the numbers before the London fix and showing you exactly how to reposition if the China proxy trade flips. If you want the full breakdown on Bitcoin and the S&P divergence, that video is live now. Tap the end screen. Smash like if this gave you a clear plan. Subscribe, hit the bell, and I'll see you in the next one. The trap is set. The levels are drawn. Now it's about execution. Trade the plan, not the noise.